Silver just hit $79 an ounce. This isn't a market fluctuation. It is a system failure. For decades, we built a financial empire on a foundation of paper, derivatives, digital claims, and the belief that physical reality could be managed indefinitely. That era is over. This is the story of a physical object breaking a digital world. The same pattern that bankrupted empires like Spain and Britain is playing out in real time, and it reveals a terrifying truth. Governments and multi-trillion-dollar tech stocks are about to discover they have absolutely no power over a physical shortage. The math says otherwise. The modern financial system operates on a fundamental lie, that paper claims are as good as the physical asset. In the silver market, this lie was perfected. Banks and speculators built a mountain of derivatives, futures contracts, options, ETFs, representing billions of ounces of silver. But for every ounce of physical metal sitting in a vault, there are dozens of paper promises floating around the system. This created an illusion of abundance. It allowed everyone to believe silver was just another industrial commodity, its price easily controlled by the levers of monetary policy and market manipulation. But silver is not just another metal. It is the most conductive element on the periodic table. It is irreplaceable. Every solar panel requires 10 to 20 grams. Every electric vehicle needs 25 to 50 grams. The entire green energy transition, the backbone of modern tech and government policy, is built on a foundation of silver. This demand is not optional. You cannot build a 5G tower or a semiconductor without it. While industrial demand quietly exploded, the supply side was systematically neglected. Silver is primarily mined as a byproduct of copper, lead, and zinc. Major mining projects take a decade to come online, and for the last 10 years, underinvestment was the rule. Why invest billions when paper markets could keep the price artificially low? The banks capitalized on this, building massive short positions. They bet, year after year, that the physical shortage would never actually materialize. They bet that their paper castle would never be challenged by someone demanding the keys to the actual physical vault. Regulators watched this entire structure grow, believing the markets could be managed forever. They forgot that every paper claim is ultimately a promise to deliver something real. And when too many people ask for delivery at once, the entire castle collapses. But the math doesn't lie. The catalyst wasn't a single event, but the culmination of 3 deliberate forces converging. The first was China's strategic multi-year accumulation. While Western financiers played with paper, China was quietly buying physical bullion, securing warehouses, and locking up long-term supply contracts. They weren't speculating. They were building a strategic reserve, understanding that geopolitical power in the 21st century is tied to commodity control. The second force was the green energy transition hitting its inflection point. Government mandates for solar and EV production created a demand surge that was no longer theoretical. It was a tidal wave of industrial orders hitting a supply chain that was already stretched thin. The deficit, which had been papered over for years by drawing down above-ground stockpiles, suddenly became visible. The stockpiles were empty. And then came the third decisive force, the first delivery failure. On the COMEX, the world's leading metals exchange, a major industrial user demanded physical delivery of a large futures contract. The entity on the other side of that trade, a bank that had sold paper silver it didn't possess, could not deliver. They had to walk away, buying back the contract at a massive loss. This was the moment the math broke. It proved that the paper price was a fantasy. The critical threshold had been crossed. Paper claims had officially exceeded available physical metal by an unsustainable multiple. The entire derivative structure, built on the assumption that only a tiny fraction of contracts would ever demand real metal, was now facing a run on the bank. Everyone who had been betting that the physical shortage was a myth suddenly realized it was the only thing that was real. The catalyst wasn't an accident. It was the inevitable result of a system that believed its own fiction for a decade too long. The first domino to fall was the most vulnerable, the technology sector. For years, tech stocks traded on a simple narrative: infinite scalability, software margins, and a future detached from the messy constraints of the physical world. The silver shortage shattered that narrative in a single quarter. This wasn't just about costs increasing, it was about production stopping. A semiconductor fab can't run at 80% capacity because it's short on silver wiring. A solar panel factory doesn't slow down. Its assembly lines halt completely when the essential conductive paste runs out. This exposes the fatal flaw of just-in-time supply chains. They are hyper-efficient in a world of abundance, but they are catastrophically fragile in the face of a single, non-substitutable physical bottleneck. An automaker can't substitute copper for silver in an EV's battery management system. A phone manufacturer can't use aluminum in its high-frequency circuits. The entire global tech infrastructure is built on the assumption that these specific physical inputs will always be available. That assumption has now been proven false. The stock market's realization was swift and brutal. Investors who priced Tesla on 70 times earnings, betting on limitless growth and expanding margins, suddenly had to factor in a new variable: production delays. A company's valuation based on shipping 1.8 million vehicles next year is worthless if it can only source enough silver for 800,000. The same logic applied to every solar company, every electronics manufacturer, every data center builder. The earnings warnings started as whispers, then became headlines. Supply chain constraints was the polite term. The reality was a physical scarcity that no amount of financial engineering could fix. The tech sector, which represents a massive portion of the S&P 500's market capitalization, was not facing a cyclical downturn. It was facing a structural revaluation. The market began to understand that these companies were not ethereal software entities. They were physical goods manufacturers dependent on scarce commodities. Their valuations, built over a decade, were predicated on a world that no longer existed. The domino effect wasn't just about falling stock prices. It was about the collapse of an entire growth story that ignored the physical foundation upon which it was built. The Achilles heel was never competition or regulation. It was the assumption that the physical world would always acquiesce to the digital one. And this is where the system reveals its ultimate weakness. The government response to this crisis will follow a predictable, historically proven pattern of failure. Because governments control fiat currency, money created by decree, they operate under the illusion that their authority is limitless. They can print trillions of dollars with a keyboard stroke, but they cannot print a single ounce of silver. This is the critical distinction that every failing empire eventually confronts: the difference between financial abstraction and physical reality. The first move will be the announcement of a strategic silver reserve release. The public will be told that the government is tapping its vast stockpiles to stabilize the market. But here's the critical detail the announcement will omit. The United States government holds 0 strategic silver reserves. The last significant stockpile was sold off decades ago. Any release would be a symbolic gesture, a few million ounces at most, against an annual industrial deficit measuring in the hundreds of millions. It would be like using a squirt gun to put out a forest fire. The market would see through the gesture instantly, and the price would surge higher on the confirmation that the government's cupboard is bare. The next desperate step will be price controls. This is a classic political response to scarcity. Instead of addressing the supply problem, they try to legislate the symptom away. They will declare a maximum price for silver. But price controls do not create more silver. They simply destroy the incentive to sell it. Why would a miner sell a precious, scarce metal to a manufacturer for a government-capped price of, say, $50 an ounce, when the global market is willing to pay $100? The result is not lower prices. It is no metal at all. The legal market for silver would vanish overnight. Production would be disincentivized, and a massive black market would emerge, making the official supply situation even worse. This tactic failed spectacularly during the 1970s oil crisis, and it will fail again. Then comes the Federal Reserve's impossible dilemma. On one hand, they could raise interest rates aggressively to try and crush demand and cool inflationary pressures. But raising rates directly attacks the tech sector's valuation, which is built on future earnings discounted at low rates. It would accelerate the stock market collapse that the silver crisis has already begun. On the other hand, if the Fed cuts rates to prop up stocks, they pour rocket fuel on the commodity fire. Lower rates make it cheaper to borrow money to hoard physical assets, sending the price of silver even higher and validating the flight from financial assets to hard assets. It's a trap. Monetary policy, the Fed's primary tool, is utterly useless against a geological constraint. They are trying to fix a physical shortage with a financial tool, and the two systems are no longer connected. The final admission will be the most humiliating. After price controls fail, after the fake reserve release is exposed, and after monetary policy proves counterproductive, the government will have no moves left. They will hold press conferences, form committees, and promise action. But the reality will be visible to everyone. They are powerless. They cannot mine faster. They cannot invent a substitute. They cannot force China to export. Their authority exists only within the financial system they created. When faced with the immutable laws of physics and scarcity, that authority evaporates. The crisis exposes that the most powerful government on Earth is ultimately powerless over a physical object. And that loss of authority is more damaging than any stock market crash. The silver shortage doesn't just break tech stocks and expose government limits. This is where the crisis transitions from a market event to a systemic threat. The unraveling begins with the massive paper short position that the banks accumulated over 15 years. For over a decade, this was a profitable trade. They would sell paper silver futures, using their market power to occasionally crash the price, then buy back the contracts cheaper, pocketing the difference. They operated with the confidence that no one would ever ask for the actual metal. But now, industrial users are asking. And the banks are discovering that their paper promises are about to become worthless. This creates a catastrophic counterparty risk event. The question is no longer about the price of silver. It's about which institutions are on the wrong side of these trades. When a major industrial user demands delivery and the bank cannot deliver, that bank faces an immediate, massive loss. But the damage doesn't stop there. That bank also had obligations to other parties. It used its theoretical silver holdings as collateral for other loans. Suddenly, that collateral is proven to be fictional. The failure of one institution triggers a chain reaction, as every other bank and fund questions the solvency of its trading partners. The entire derivatives market is a web of interconnected promises, and the silver shortage is the pin that starts pulling the threads apart. The regulatory response to this will be a clear sign of desperation. We've seen this playbook before. The first move will be to change the rules of the game mid-collapse. The exchange, like the COMEX, will suddenly announce emergency measures. They might increase margin requirements exponentially, making it prohibitively expensive to hold positions. They might restrict trading altogether, or even permit the settlement of contracts for cash instead of physical metal. These actions are not taken to stabilize the market. They are taken to prevent a total institutional collapse. They are an admission that the system cannot handle the consequences of its own design. It's the financial equivalent of a building inspector, seeing a skyscraper start to tilt, declaring that gravity no longer applies. The ultimate casualty is the loss of faith. For decades, the global financial architecture has been built on trust in these paper instruments. Investors trusted that a futures contract was a real claim on a real asset. They trusted that an ETF share was backed by physical metal in a vault. The silver crisis proves that this trust was misplaced. When people realize that the entire derivatives structure is vulnerable to a run on a single physical commodity, the faith in the entire system evaporates. This loss of confidence is more dangerous than any single bank failure. It means that the very foundation of modern finance, the belief that paper can reliably represent value, is broken. The contagion isn't just about losing money. It's about losing the narrative that held the entire system together. To understand why this collapse is inevitable, you need to see the pattern. It's written in the ruins of empires. Stage 6 is where we look back and realize this has happened before. The details change, but the mathematical certainty of physical reality overwhelming financial abstraction does not. Start with 16th century Spain. They discovered mountains of silver in the New World and flooded Europe with the metal financing their empire. But they made a fatal error. They believed the silver itself was the source of their power, not the productive capacity it could build. They spent it on wars and luxury imports, neglecting their own industries. The result was hyperinflation. The massive influx of silver devalued the currency, making Spanish goods uncompetitive. The empire that controlled the physical commodity was ultimately bankrupted by it because they confused the metal with real, sustainable wealth. The physical asset, mismanaged, became the instrument of their collapse. Then, fast forward to the British Empire. For a century, the British pound was the world's reserve currency, backed by the immense productive power of the Industrial Revolution and the gold standard. But the cost of 2 world wars shattered that foundation. Britain emerged from WW II drowning in debt. Its industrial capacity weakened. To fund the war effort, they had printed money far beyond their gold reserves. The system was a fiction. In 1967, the pressure became too much. Facing a run on the pound, the government was forced to devalue the currency. This was a formal admission that the financial power of the British Empire was no longer backed by sufficient physical and economic reality. The loss of reserve status was a direct result of the gap between paper claims and tangible strength. And then there's the modern preview, the Hunt brothers in 1979. Nelson Bunker Hunt and William Herbert Hunt attempted to corner the silver market. They accumulated nearly 100 million ounces of physical metal, driving the price from $6 to nearly $50. The government's response was telling. They couldn't simply confiscate the silver. The Hunts owned it legally. So they changed the rules. The COMEX dramatically increased margin requirements, making it impossibly expensive for the Hunts to maintain their leveraged positions. This triggered a margin call the brothers couldn't meet, forcing them to sell and causing the price to collapse. The government only succeeded because the Hunts' position was built on debt, a financial vulnerability. The lesson was clear. If you own the physical asset outright, free and clear, the government has very few tools to stop you. The Hunts failed because their strategy was financial. A shortage driven by genuine industrial demand and owned physically is a completely different beast. The common thread through Spain, Britain, and the Hunts is the belief that financial engineering can triumph over physical reality. Spain thought infinite silver meant infinite wealth. Britain thought its financial prestige could survive the erosion of its industrial base. The government in 1980 thought rule changes could solve a physical accumulation. Each time, the physical reality won. And this time is different in one critical aspect. The scale of industrial demand is unprecedented and non-discretionary. The green energy transition is a government-mandated trillion-dollar project that requires silver. This isn't two brothers speculating. It's the entire structure of the modern global economy hitting a physical wall. The historical pattern says that when this collision happens, the financial system always loses. While institutions panic and governments flail, a quiet revolution is happening at the individual level. Stage 7 is the retail investor awakening. This is the moment the narrative breaks for the person watching their portfolio, and they realize they've been trusting a system built on paper. For years, the mainstream financial advice was clear. Silver is a volatile industrial metal. It's not a serious investment compared to stocks and bonds. That narrative is now collapsing in real time. The first crack appears with the failure of the paper proxies. Investors who thought they owned silver through an ETF like SLV are now reading the fine print. These funds are supposed to be backed by physical metal, but the mechanism is fragile. When delivery failures hit the futures market, It calls into question whether the ETF custodian can actually acquire the metal to back new shares. Savvy investors start asking the question, do I own a share of a silver fund? Or do I own a financial promise that may not be redeemable? This doubt triggers a rush for the exits, but not out of silver entirely. They rush out of the paper representation and into the physical asset itself. They start taking delivery of coins and bars, or moving their ETF holdings into allocated, auditable vaults, where their name is on a specific bar of metal. This is a fundamental psychological shift from trusting an intermediary to trusting only what they can hold in their hand. This awakening is amplified and accelerated by social media and digital communication in a way that was impossible during past crises. Warehouse reports of low inventory, screenshots of delayed delivery notices, and analysis of COMEX data spread instantly. This creates a collective intelligence that bypasses traditional financial media, which is often slow to acknowledge a systemic break. The message is clear and undeniable. The physical market is separating from the paper market. A new generation of investors who grew up with digital everything, digital money, digital assets, digital identities, is having a profound realization. They are discovering that the ultimate hedge against a failing digital system is a physical object that cannot be hacked, inflated, or deleted. They are experiencing a psychological break from the entire concept of trusting paper financial instruments. This isn't a speculative frenzy. It's a loss of faith manifesting as a rational action. When people see tech stocks crashing because of a physical shortage, and they see the government powerless to respond, they draw a logical conclusion. They realize that their wealth, stored as digits in a brokerage account, is vulnerable to the same systemic failure. The only way to protect it is to convert some of those digits into something that exists outside the system. The retail awakening is the final piece of the puzzle. It means the demand for physical silver isn't just coming from industry and billionaires. It's coming from millions of individuals who have lost trust. And when the public stops believing in the system is already finished. The run on the physical metal by retail investors is the vote of no confidence that no central bank can reverse. The silver crisis is not a random market event. It is a geopolitical checkmate, years in the making. While Western financial centers were obsessed with derivatives and stock market multiples, China was playing a different game entirely. Their multi-year, deliberate accumulation of physical silver was not a speculative trade. It was a strategic maneuver to control a critical input of the 21st century economy. This positions China as the ultimate price setter. They are not just a participant in the market. They are, effectively, the market for physical silver. When you control a significant portion of the remaining above-ground stockpiles and a large share of the refining capacity, you don't react to prices. You dictate them. This is the weaponization of commodity supply. For decades, geopolitical power was measured in aircraft carriers and nuclear weapons. In the 21st century, it is increasingly measured in control over the physical resources that enable technology and energy. China understands that you can have the most advanced semiconductor design, but if you cannot source the silver to manufacture it, your design is worthless. By creating a chokehold on silver, China gains immense leverage in any broader geopolitical conflict. It's a form of power that is far more subtle and devastating than a tariff or a sanction. It is the power to simply turn off the tap for critical industrial input, bringing entire sectors of a rival's economy to a halt. And here is the critical weakness it exposes in the West: the inability to respond. What can the US government do? Launch a diplomatic protest? China will ignore it. Impose sanctions? That would only accelerate the decoupling of supply chains and guarantee that zero silver flows westward. Attempt a military solution over a metal? The idea is absurd. Every conventional tool of statecraft fails because the West's vulnerability is structural. Its economy is built on a just-in-time model that requires a constant flow of commodities it does not control. China's strategic win is total because it exploits a dependency that Western policymakers deliberately created and then ignored. The shift in financial power is now undeniable. For 50 years, power was held by whoever controlled the world's reserve currency. Now power is shifting to whoever controls the world's essential commodities. The new reality is that geopolitical supremacy requires physical commodity control, and in the case of silver, that control has been decisively seized. The silver shortage is the canary in the coal mine for a much broader inflationary fire. Up to now, central banks have been able to frame inflation as a temporary problem, a series of supply chain kinks that would eventually resolve themselves. But you cannot resolve a geological constraint. When the shortage is in a fundamental, non-substitutable input like silver, the inflation it triggers is not transitory. It is permanent and it is structural. This is because the breakdown is not in logistics, it's in availability. The price signal is not a fluctuation. It is a rationing mechanism for a resource that has physically run out. The single point of failure now cascades through the entire economy. The process is brutally simple. A halt in solar panel production due to silver scarcity means fewer solar installations. That reduces energy supply, putting upward pressure on electricity prices for everyone. A slowdown in EV manufacturing means more reliance on gasoline, pushing up oil prices. A delay in semiconductor production means shortages for everything from cars to appliances, leading to higher prices for all durable goods. The just-in-time supply chain, which was designed for hyper-efficiency, becomes a hyper-efficient transmission mechanism for inflation. A shock in one single commodity reverberates through every connected industry, multiplying the initial price increase. This dynamic creates the central bank's ultimate nightmare, a wage price spiral triggered by supply destruction, not demand. Traditionally, inflation is fought by raising interest rates to cool off consumer demand. But this inflation is different. It's not that people are buying too many iPhones, it's that Apple can't make enough of them because a key component is physically unavailable. Raising rates in this environment doesn't create more silver. It simply crushes the parts of the economy that are still functioning, destroying jobs and demand, while the supply-driven inflation continues unabated. Workers facing higher prices for energy, transportation, and goods will demand higher wages. Companies facing higher input costs and higher wage bills will raise prices further. The central bank is trapped. It must choose between financial stability, by letting inflation run wild to avoid a depression, and price stability, by crushing the economy with rates so high they trigger a deflationary collapse. There is no soft landing when the runway itself is collapsing. The inflationary spiral accelerated by the silver shortage exposes the fundamental powerlessness of monetary policy in the face of a physical reality it cannot alter. The tools they have are designed for a world of abundance, and that world is gone. The final stage is not a collapse, but a reset. The system built on paper claims cannot survive a permanent physical shortage. The endgame has only two likely outcomes. The first is a controlled demolition, where regulators and central banks orchestrate a managed debt jubilee, writing off the massive paper losses to prevent a total systemic meltdown. The second is an uncontrolled collapse, a cascading failure of trust that wipes out the derivatives market entirely. Either path leads to the same destination, the revaluation of all assets based on physical scarcity, not earnings multiples. Bilateral trade agreements, backed by commodities instead of dollars, will bypass the old financial architecture. The new system that emerges will be built on one simple, brutal principle. What is real matters more than what is promised. This story isn't about silver. It's about the inevitability of physical reality. The system's vulnerability was mathematically certain the moment paper claims exceeded physical supply. The pattern that broke Spain and Britain has repeated. Subscribe to Economy Rewind, because this is just the first impossible collapse. Others will follow as we hit more physical limits.